Many people have been concerned that they have not been able to get that refinancing rate they had hoped for when they bought that house during 2000 and say 24. Rates were high and they thought, well, I'll go ahead and buy that house because the Federal Open Market Committee is likely to reduce rates. And that happened. They did reduce rates. Some people delayed buying the house that they wanted because they thought, well, I'll just wait until mortgage rates go down. And as they saw the Federal Open Market Committee lowering rates during 2024 by about 1%, they expected mortgage rates to fall. And this is a misconception that the Federal Open Market Committee determines rates for mortgages. What they actually do is determine the rates that banks charge each other, not what your mortgage will be. Now, maybe in years past, there has been more of a correlation than there is today, but these days, the correlation simply isn't there. So let me explain a little bit about how the market actually works as opposed to the way some market pundits, market people that just get on the news and talk about things may have you believe. So what happens is the Treasury, the U.S. Treasury, looks at what the upcoming expenses are for the U.S. government, and they determine what the need is going to be and how much it's going to take to fund that. And as we all unfortunately know, the U.S. government has been operating at a deficit, spending more money than they're taking in taxes and other things. So there's a need to raise funds, and they do that by issuing Treasury bonds and notes. So what happens in actuality is the Treasury must then determine how much they need, and then based on that, the old Economics 101 comes into effect: supply versus demand. So who out there wants to buy our billions of dollars worth of debt? Individual consumers, companies, insurance companies, countries. And countries, other countries, are actually the ones that own the most of our U.S. treasuries. What are they willing to pay? And that determines the rate at which they're going to need to supply to the market in order to raise those funds to fund government spending. And that rate is what you hear quoted on the news. And that rate is what, generally speaking, determines your mortgage rate, the 10-year Treasury. What essentially all of the world market sentiment decides the rate should be. So what happened during 2024 is that while the Federal Open Market Committee did lower the rates that banks charged each other, that did not translate into what the rest of the world and the rest of the market felt that they needed in order to give up the right to use that money for other things. So you have to have a few things, right? Number one, you have to agree, if you're a foreign country, to own US dollars. Number two, you have to agree to own those dollars for a certain length of time. And number three, you have to determine whether or not you're going to actually make a real return on that money that you invested over the next however long that term is, whether it's a 10-year treasury, a 1-year treasury, or maybe a 15 or 30-year treasury, whatever that is. So the market determines what that coupon rate is that they will pay, that the U.S. Treasury will pay, in order to get those funds and get people to give up the use of that money, hold U.S. dollars, and expect a general rate of return. And that translates into the 10-year Treasury, which is what determines your mortgage rate. And what happened during the 2024 is, with inflation rising and with many other geopolitical events going on throughout the world, plus a presidential election here in the United States, the actual 10-year Treasury rate went up while the FOMC funds rate was declining. And that's why your mortgage rate didn't really go down as many people expected. You see, their mortgage rates and the U.S. Treasury, which determines mortgage rates, are much more determined by market sentiment, global market sentiment, not just market sentiment and how people feel about the markets here in the United States, but worldwide, because most of our U.S. Treasury debt is actually purchased and held overseas by foreign governments, sovereign wealth funds, and very large corporations that don't usually use dollar-denominated assets. So they also have what we call currency risk that they have to be concerned with. So that kind of gives you a general idea of why your mortgage rate didn't go down and why it may not go down as much as you might expect into the future. And now the Federal Open Market Committee, as we head into 2025, I'm dating this video a bit, is talking about not even lowering rates as much as was expected going throughout the year of 2025. Of course, we don't know what they will do. But what we do know is that right now our federal deficit continues to grow, so there's much more supply. And will that demand be there? Are Treasury rates likely to go up or likely to go down? And I'm not in the business of forecasting things like that to any great degree, but I can tell you a massive mistake and misstep that many investors are making is another fallacy in the market that many people talk about as fact, and that is the idea that bonds move in an inverse direction than stocks do. And the idea was, and this worked many years ago, 20, 30 years ago, it worked very well, where you could own some bond portfolios, say treasury bonds or corporate bonds, and that would, to some degree, offset your risk to your equity securities. So there was what they called the 60-40 portfolio, and you'll find many arguing today that this still works. If you look at the math behind it and the reality of it, much like many people think the Federal Open Market Committee sets mortgage rates, that's not true. Well, much like that, the idea that the risk of stocks and bonds are opposite each other and can offset has not worked in many, many years. So I hope you take that to heart as you're planning for your retirement and think about where you might get your income and where you might be able to offset some of the risk involved with owning equity securities and balancing that out. Because there are strategies and there are tactics that you can use to offset that risk, but you have to go where the market has already been and is going and is right now. You can't rely on history. History is no guarantee of future results. And of course, this video is not investment advice. You need to reach out to us at guardianrockwealth.com and we can give you one-on-one personal investment advice. And we'd love to do that. But you have to work with what's available today in order to reduce your risk so that you know and you have confidence that you'll have the money that you need to fund your lifestyle in retirement and live your best life. So I hope that you will take that to heart and reach out to us. We are taking new clients throughout the United States, and I hope you have a great rest of your day. This is John Browning, Guardian Rock Wealth out of West Palm Beach, Florida.